It's time now for a Muni Moment with Taylor Riggs. It's our segment that focuses on the top stories in municipal bonds. Taylor.
Vonnie, of course, this week we're talking about the cap on SALT deduction, the financial pressure that's putting on some states who can't raise revenue because taxpayers are now more burdened by that $10,000 cap on SALT deductions. Joining me now to discuss this is Shawn O'Leary from Nuveen Asset Management. Shawn, great to have you here. You know, you're in Illinois, I'm in California. How much pressure are these high tax states from a revenue perspective really feeling from this?
You know, a fair bit. We have 15 states that are already above the $10,000 average cap on the SALT deductions. So, you know, those states that are the high tax jurisdictions, they're going to be struggling with how they can increase taxes in the future and mitigating the impact on their taxpayers. So I think that's why you're going to see states try to look at the models that are being developed in California and New York and consider ways to work around the SALT deduction caps. But I think it's also important to remember that these SALT deduction caps don't eliminate or reduce any existing levies. It's more of a hurdle to future levies.
Now, talk to me about, from the credit perspective, what you're seeing. Of course, on the state level, they have more flexibility. I'm thinking more on the local GO level. How much pressure do they feel?
You know, it's a new factor to consider for us. So I think you have to go through a couple of decision trees. The first is for a local GO, a local credit, are they in a high tax jurisdiction or not? If they're in a high tax jurisdiction, do they have at their local board level the ability to raise taxes or not? That's probably a bit of flexibility that works in their favor. But if they need voter approval, then it's more of a decision case or a study of, are they able to convince their voters that these taxes are necessary, or they can be transparent about it? Can they, you know, educate their voters as to why they need the money? Their ability to do that successfully or not will dictate how they'll shake out on a kind of a credit perspective going forward.
I'm putting you on the spot a little bit here. Are there any specifics, any sectors or certain credits that you can talk about that you like or don't like?
Well, it's not about like or don't like, but as it pertains to SALT here, you know, it's more about understanding local governments and things. You know, nationwide, in terms of how we invest portfolios, credits and sectors that we like or don't like, it's more of an individual basis, or, you know, on a relative value basis. Are we being compensated for that particular credit or not, and less about whether we like the sector.
Shawn, just to wrap it up here, interestingly enough, you say in your recent note that the cap on SALT deductions is temporary. It expires in 2025. Are the odds sort of in the favor of reverting back to having no cap and giving states back that sort of revenue-raising flexibility?
We think so. If you look at history here, in order for the SALT deduction cap to be extended, it needs an active vote by Congress. It most likely has to be a unified Republican Congress and presidency. To do that, any other mix, you likely don't get the political support for extension of the SALT deduction cap. So looking back at the last 50 years of Congresses and occupants of the White House, there's only been 6 where you've had that particular makeup that we think is necessary to extend the deduction cap.
Thank you. That was Shawn O'Leary, Senior Research Analyst at Nuveen Asset Management.